Here to discuss is Chris Senyek. He's chief investment strategist at Wolfe Research, and he told us back in February that the SPAC bubble was bursting. Chris, is it bursting for good?
Hi, Kelly. Thanks for having me. Yes, I think it's bursting in large part for good. I think it was a byproduct of the easy money era that we had with physical and monetary stimulus. And when we normalize to a new environment, I think the large SPAC issuance that we've seen and large SPAC deals we've seen will be long gone.
There are still 600 SPACs searching for an acquisition target. Is that right? And shouldn't this be now a ripe time for finding cheap, attractive targets? We were just talking with Courtney a little while ago about Gap. I'm not saying that, I understand they have to be private, but there's plenty of distressed assets out there, aren't there?
There are. I mean, there's more and more every day. I mean, small caps, if you know, have been decimated more so than the broader market. And I think there's just a valuation issue, a kind of wide bid-ask spread where investors maybe think the valuation of the business is one thing, and the companies or the sellers think it's something else, where they use, what it used to trade at perhaps 6-12 months ago and haven't kind of come to reality that the valuations are lower and will likely stay that way.
I also have to imagine if you are a company that was hoping for a traditional IPO or some kind of exit, maybe you've raised some funds, maybe you need to, give a payout to your early employees and so forth. Wouldn't a SPAC still represent a good liquidation opportunity and a good liquidity opportunity?
Yeah, well, it is. And they're going to have their place, right? So they are still, I think, in the long term going to exist in the market. They're just going to be smaller deals, maybe more geared towards early stage biotech and the tech sector more in general. The other issue, which is, I think, put a wet blanket on SPACs, has been the proposed SEC rules on SPACs, which make them more in line with IPO disclosure requirements. You can't use those hockey stick forward projections in your numbers anymore. So I think companies will sit there and say, should we really do a SPAC or should we just do a traditional IPO, which may be a little bit simpler and easier kind of going forward?
Anything you'd say, so for investors who are always hunting for opportunity, some of the SPACs that did complete are trading at a penalty because of that. They've been tarred with this brand name, for instance. Should we go looking for opportunities in an asset class like that, or do you think that it is a red flag across the board?
No, I think you can't paint all SPACs with the same brush. There are some SPACs that went public. They're good, real businesses. They're generating cash flow. They're trading on GAAP earnings. They're not trading on total addressable market or revenue. And I think as we see more and more volatility over the coming weeks and months, you can pick up some good businesses at attractive prices. You just have to be very careful. You have to focus on profitability, low leverage, higher earnings quality, and what is currently going on in the business, not what might happen in 3 to 5 years. And and a good number of businesses that went public that are decent.
No, we'll bring you back. Maybe we'll do 3 buys and a bail SPAC edition just for that purpose. Chris, thanks so much for your time.